For generations, we've been taught a simple rule about money. To keep it safe, you lock it into a fixed deposit. It is easy to see why. The returns are guaranteed from day one, and you never have to worry about the stock market suddenly wiping out your savings. You hand over your cash, and in return, you get an ironclad contract, a physical promise that your money will grow exactly as planned. Because the numbers never go down, we convince ourselves that our financial future is completely protected. But what if that money, sitting perfectly undisturbed in a bank account, is actually losing its power day by day? There is an invisible pressure that easily breaches even the thickest bank vaults. That unseen force is inflation. It doesn't arrive as a dramatic market crash. It operates as a silent, daily tax on your savings, skimming off the top while you sleep. The ultimate risk to your savings is the steady, unchecked erosion of what that money is actually capable of buying. Let's deposit $10,000 into a standard fixed deposit today. Assuming an average holding period and a standard interest rate, your contract guarantees you will have around $12,000 5 years from now. This chart shows exactly what that looks like. It traces a steady, upward path, mapping your guaranteed growth year over year. Opening your banking app and seeing those raw numbers climb higher gives you a genuine sense of accomplishment. But focusing solely on your account balance obscures a vital economic reality. We have to measure those same 5 years against the actual cost of living. Adding to this chart, we see a second line tracking everyday expenses like housing, food, and energy. It climbs faster and much steeper than the interest you earn. Notice the widening space between the two lines. That shaded area is your mathematical deficit. The interest you earned over those 5 years might pay for a month of groceries, but those exact same groceries now cost significantly more than they did when you first deposited the money. You possess a larger quantity of currency, but a smaller capacity to actually buy goods. When the cost of the world around you rises faster than the numbers in your account, your perceived wealth is an illusion. To accurately judge any investment, we have to rely on a single unforgiving metric: real return. This graphic shows the formula. Your real return equals your nominal fixed deposit interest minus the inflation rate. When we plug in recent economic data, say a 5% deposit rate minus a 4% inflation rate, your actual profit collapses to near zero. This data defines the specific role of the fixed deposit. It functions well as a temporary shelter for emergency funds, but the math proves it cannot generate the surplus growth needed to actually expand your net worth over time. If you ignore the real return equation, you ensure a slow financial decline, all while feeling perfectly secure. If traditional banking cannot outpace the silent drain of rising prices, we have to find a new place to store value. Historically, people have turned to the oldest alternative to the bank vault: gold, a tangible asset with physical weight and thousands of years of history. But we have to ask the same hard questions. Does gold actually multiply your wealth, or is it just another static holding pen for your money? Before you lock your money away, you must always measure what it can actually buy.
लाइक शेयर सब्सक्राइब कर दो यार।